Good afternoon. Welcome to the weekly livestock market update. I'm Brownfield anchor reporter Meghan Grebner. With us as always to talk all things markets, University of Missouri, Scott Brown. Good afternoon, Scott.
Happy Friday, Megan.
Happy Friday to you too. It has been a week. All right. There's really not a ton for us to get into this week. We're not going to talk about any reports. We get to chit chat a little bit more about some global events and some other things going on. But to kick things off, let's recap what happened this week in the markets.
Yeah, this week on the cattle side, cash cattle were 25 cents higher on the week. Those feeder cattle markets were $2 to $4 higher this week. We also saw strength on the future side. The April live cattle futures contract was up $3.50, and the April feeder cattle contract was up $5. I think part of that higher feeder cattle contract was what was a 21.5-cent decline in May corn futures this week as well. The choice box beef price gained nearly $4. We had strength across the board in all of those components this week, and that actually puts that choice box beef price about $30 above where it was a year ago at this time. On the hog side, cash barrows and gilts were 30 cents higher this week. The April live hog futures contract was down $3.35, and we got a 25-cent increase in the pork cutout value as stronger bellies slightly outweighed what was weaker ham and loin prices this week.
It's really been interesting watching just the volume of cash trade going on the hog side of things too. How much are we watching supplies and its greater implication to the market?
Yeah, so I think we have to keep watching them on the hog side in particular. You know, we're seeing some smaller runs of slaughter each week. I think it might point to us that we don't have quite the hogs out there that maybe we would have thought from the last hogs and pigs report. So maybe that's positive news in terms of some higher prices if we keep hog inventories at these lower levels.
Well, we'll find out here in a couple of weeks. Quarterly hogs and pigs report comes out at the end of the month. We're finally going to talk year-to-date comparisons in terms of slaughter, but let's talk a little bit about slaughter numbers this week for both cattle and hogs.
Yeah, so USDA tells us for the week ending March 19th, a run of 644,000 head of cattle. That's basically unchanged from where we were a week ago, Megan. And if we look at that weekly number relative to a year ago, it's up 15,000 head. On the hog side, a run of 2.435 million head of hogs this week. That's 40,000 head below where we were a week ago and 89,000 head below where we were a year ago at this time. The year-to-date numbers, just to start to give us a little bit of sense here. So cattle slaughter basically unchanged year-to-date, while we're talking about hog slaughter that's 7.1% below year-ago levels when we look at year-to-date. So some of those early weeks in January continue to keep that hog slaughter number well below year-ago levels.
All right, that's it. See you next week. No, I'm just kidding. Really, that's really the bulk and the meat of what we have to get into today. But we're going to talk a couple of current events. And for those who might be watching on Facebook Live, if you have a question for Scott, I'll let you throw him a curveball today. I'm always up for that. Let's start first and talk drought conditions. We're still extraordinarily dry, and we are very dry in some of our major cattle producing areas. How do we talked about this a year ago, right? Like drought set in early and it's not really let up in places like South Dakota. Nebraska is really dry. What does this mean for cattle numbers moving forward this year? What does it mean for hay supplies? And how does that roll into profitability?
Yeah, so it certainly adds some dynamics here that we have to watch. I always have said I don't like to talk drought in winter months when we aren't growing grass, but winter's behind us, so it's getting that time of year where we have to start thinking about what's really happening. And I'll say maybe a little early, but in places like Texas and Oklahoma, we're talking about the start of grass growing season has already unfolded. So we know we had the wheat pasture issues that pushed calves into feed yards sooner, but now we have the added thing of what's grass growth in what's big states, right? I always say everything's bigger in Texas, and the beef cow herd is just one of the things that is bigger in Texas. When you look at the data, 80% of Texas now in a D1 or worse condition from the drought standpoint. Oklahoma setting more like 85 to 90% in that D1 or worse. Those compare to 30 or 40% kind of long-term average. So we're seeing a different part of the country that's dry right now, which reminds me to say those are the top 2 beef cow states in the country. It likely keeps beef cow inventory in check, especially on top of that. You talk about what are going to be higher hay prices with hay stocks that are tied and likely not a lot of expansion in hay harvested area this year, given the strength in corn and soybean prices. So input prices stay high as well. And you alluded to, you can look Nebraska, South Dakota, Montana, still as bad as it was last year. So I go North Dakota, all right, so it's better. Percent D1 is setting about 50%, yet the long-term average would be less than 20, so it's still pretty dry there. But in comparison to a year ago, when they were 90% D1 or greater, it's better. It's just relative to the long-term average, they're still dry.
And they're not dry, they're warm and dry. I mean, like, so we're starting to see things come out of dormancy in some parts of the country that normally would still be dormant, not up out of the ground yet. How does that put even more pressure potentially on supplies and inputs on the feed side moving forward?
So potentially, it's good we're having this discussion, because I want to go back to the cattle report for a minute, because I think there's some interesting pieces. So when you look at the state by state numbers, all right, so we've basically been saying drought has caused the reduction in beef cow inventory in this country. The dry weather of the northern plains last year and the West led to fewer cows. Yet I look at a state like North Dakota that was down 20,000 head January of this year to a year ago. That's, to me, was not nearly a large enough decline. South Dakota was down 190,000 head. I got that. That's drought. But the North Dakota number for me kind of made me scratch my head. Now, equally making me scratch my head is the 95,000 head decline in Missouri. We didn't have that much dry weather in Missouri in 2021. So are we finding hay and pasture acres that are more than happy to grow $16 and $17 a bushel soybeans? And are states like Missouri losing cows to these alternative enterprises that are seeing a pretty good run up in prices? It's just confusing the picture. And I want to remind everyone that there's got to be more going on than drought, given the decline in the beef cow herd we've seen of late.
So we talk about a run up in prices. We look specifically, while corn may have been down this week, but corn prices going up on the cattle side. Soybean prices have been on the rise. Wheat prices have been, wow. I mean, like, I don't even know how to talk about the run up that we've seen in wheat prices. And a lot of this is coming from global disruptions, global tensions, what's going on with Russia and Ukraine. How does that play into the big picture for livestock and cattle and hog producers? Because you surely can't turn your nose up and say, well, it's row crops. It's not, it's not my problem, but it is when we think about inputs and profitability in the long term.
So I think the uncertainty of the cost side of the equation is just another factor that's going to keep the supply side of beef and pork production, and for that matter, chicken production, growing more slowly or not growing at all, just given that uncertainty. For cattle in particular, do I worry this fall if corn prices stay as high as they are, that feeder cattle prices can't maintain some of the strength that we've seen of late? Yeah, that certainly could be the case. I don't know how you feed, $7.50 corn and make some of that work. But for me, the issue really here is the volatility that we're seeing right now. What's the perfect decision today becomes the absolute wrong decision tomorrow. That's not so much fun. as a producer to try to deal with that. I don't have an easy answer of how to deal with that volatility. I just say make sure if you decide I want to reduce the risk, that you do it both on the input side and output price side of the equation, given the extreme volatility we see right now.
So as we talk about risk management, we know we've talked a lot about locking in prices that keep you on the input side of things. But what about ways to protect us on the price side of things for livestock? How do we mitigate some risk there, but also maybe take some of the uncertainty out of that conversation?
Yeah, so sometimes I'll talk about the chance to use the LRP program that's a part of RMA, or crop insurance, if you will. So it's almost like a put option, subsidized put option. So your cost up front of getting rid of the risk, but you also then don't lock yourself out of any upside if it were to happen. For a lot of producers on the cattle side, they don't have enough cattle to talk about a whole contract or a mini contract. And I say, although don't tell your crop insurance agent, I say this out loud, you can do one head via LRP. So it fits for small and moderate sized producers as well. That's one way to do this. And I will keep saying, find ways to protect your downside, but leave yourself as open as you can to the upside, just given where these markets sit today.
And don't exclude yourself out of risk management just because of your herd size, right?
That's right. Even though you're small, there's ways to reduce risk, and even to the point where, so a lot of times I'll hear from smaller producers who are trying to do some value added opportunities, and I go, it's okay to pursue those value added opportunities. It's also okay to use traditional commodity prices to help reduce some risk that you face as well, because your value added price likely is correlated very nicely with commodity cattle prices. And so you can still reduce some risk by the traditional tools that we have.
Scott, that kind of does it for us today.
It's a nice short week, right?
Short, sweet, and to the point. Next week, not so much, as we take a look to next week's reports. What are we watching for?
Yeah, so midweek we'll get cold storage, and then livestock slaughter, and finish the week with cattle on feed.
Someday livestock slaughter will come before cold storage.
There you go.
I'll just keep saying my prayers tonight. All right, Scott, great to see you. We'll talk to you next Friday with a full week of reports.
Have a great weekend, Meghan.
You too. To have our weekly livestock market update emailed to you every Saturday morning, go to brownfieldagnews.com. You can also submit questions and comments there. And if you're looking for some great podcast material while you're on the road or in the field, go to brownfieldagnews.com/podcast. Have a great weekend. I'm Meghan Grabner for Brownfield.